What's up everyone, it's Scotty with Money Investing. So in today's video, we are going to be talking about Disney, Walt Disney, ticker symbol DIS. A lot of you guys have been asking questions about this company, about this stock. So I figured I'd do a video because they are going to be reporting earnings next week. So it's going to be incredibly important to analyze, of course, the intrinsic value because it's actually coming down to a very critical area of support and also very much in line with my fair value as well. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining, the first week of the month, like I said, is the best time to take advantage of those deals and of course join our money investing community. You get access to all the buy and sell alerts, options alerts, trade ideas, intrinsic value spreadsheets, members only private videos. Everything's going to be included with the link down below. So first things first, let's talk a little bit about what the expectations are and what the market's pricing in. So right now, again, they're going to report on August 9th after the markets close, and the EPS expectations are just a little bit under $1 per share. On a GAAP basis, it's only 5 cents per share with revenue pegged at over $22.5 billion. And the critical thing here is that there are over 19 downward revisions on Disney. Right? So the expectations have been set really low because of all the downward revisions. So if they come in with a strong beat, it's possible the stock pops here after the market closes on August 9th. Now, obviously, we know that they've got separate, different, multiple businesses, direct-to-consumer, licensing, streaming, entertainment, theme parks, all these different things. But this is the second quarter 2023 results where the revenue did grow on a year-over-year basis. So we are seeing Disney now, once again, growing from entertainment and international park business more than streaming. So obviously, streaming is a fairly new business for Disney. And that's really what kept them afloat during the COVID-19, during the pandemic. But now we're seeing that normalization where the growth in the streaming business is not as high, but it's being offset and being compensated by the growth in their theme parks and entertainment business. So revenues were up 21.8 billion, up from 19.2 same time last year. We had income from operations 2.1 billion. Total segment operating income 3.3 billion, which was a little bit lower from same time last year, but diluted EPS was up to 69 cents per share. And of course, excluding certain items was up to 93 cents per share, slightly lower than same time last year. Now, linear networks here, this was the revenue for second quarter, media, entertainment, distribution centers. So linear networks was down a little bit over $6.6 billion from same time last year. And they specifically mentioned that the decline in operating income versus prior year was primarily driven by decreases in $800 million of our domestic linear networks and $160 million at international linear networks. Lower cable results were largely due to the higher sports programming and production costs. Lower broadcasting results reflect a decrease in advertising revenue across the ABC network and our owned television stations as well. But we did have direct-to-consumer increase from 4.9 to 5.5 billion dollars, and we also did have the content sales and licensing, which is their CSLO revenue segment, increased from 1.9 to 2.2 billion dollars. Again, operating income, we already went over why it declined. We also saw declines for across the board for all other or revenue segments as well. So this right here is going to be their Disney Core and Disney Hotstar. So we're sitting at just over 104.9 million core subscribers, which was increasing, right, obviously from 104.3, and year over year, very strong growth as well. So again, 17.3% growth here compared to second quarter last year and 0.6% growth sequentially. So definitely slowing down a little bit. And we did have Hotstar subscribers also actually decline on a quarter over quarter basis, still increasing year over year, but definitely declining on a quarter over quarter basis, decreased by 4.6 million versus the prior quarter. They didn't give any reasoning as to why, and also mentioned that ARPU decreased by 15 cents versus the prior quarter due to lower per subscriber advertising revenue as well, because obviously the subscriber drop was pretty substantial, and as a result, the ARPU did decline to $4.44. That's going to be a little bit higher, but again, Hotstar was down to 59 cents. That's the overall global average revenue per user. Disney Core did increase to 647, but Disney Hotstar did decline both on a quarter over quarter and on a year over year basis for the company. Now, when it comes to Hulu subscribers, they did increase both on a year over year basis and on a quarter over quarter basis, and ESPN also did increase to 25.3 million. So I think their total subscribers here right now, if I can do very quick math, is sitting roughly at over 170, 180 million, somewhere around that number. Of course, Netflix is way far ahead, over 300 million. Of course, Apple TV is catching up. YouTube TV is obviously catching up, but YouTube as a whole platform is obviously very, very strong. Now, when it comes to the parks experiencing the other segment, domestic parks experiences, international parks experiences, now this is where the growth is coming from, right? So 1.1%, 17% growth on a year-over-year basis. Domestic parks experiences, you'll notice, went from 4.9 billion to 5.6 billion. International parks pretty much doubled from $600 million to 1.2 billion. And consumer products were the only one that did see a little bit of a decline. And they mentioned that decrease in operating income revenue prior year was because of lower merchandise revenue from certain franchises as well. But again, international, domestic parks experiences, that's where the growth is coming from. That's where it's kind of shifted a little bit away from streaming over to parks and experiences, as of course the economy's opened back up for the last couple of years. Now, this right here is going to be their upcoming theatrical releases. Now, to be honest, like, I'm not super familiar with them. Like, maybe the Marvels, will be something that's interesting to me back, going forward in November. But everything else, obviously there's going to be a lot of other titles and a lot of other releases that are going to be interesting to other folks. But to me, there's only maybe like one, maybe a couple that are interesting. This right here is the overall revenue numbers, right? So $45 billion in 2013, growing that to over $82 billion last trailing 12 months, $87 billion. Gross profit also very, very strong, going from 20 to 28 billion. Operating income has been a little bit back and forth because, again, the revenue mix, most of the revenue came from parks, entertainment, experiences, and that was the one that basically collapsed in 2020, 2021 because of the pandemic. But the streaming business kept them afloat, and now it's recovering, right? So now we're already back up to $7.4 billion in operating income because you had revenue drop a little bit, and then the actual operating expenses increase, right? Operating expenses were still the same, if not more, right? So you can see that pretty much the total operating expenses continue to increase every single year. It's gone from 10.5 to $21.4 billion, while the revenue remained constant, right? Revenue was not increasing at the same pace as operating expenses, and as a result, the operating income was basically collapsed, and then now it's starting to recover a little bit. This right here is going to, again, be the EBITDA. Did get affected a little bit during the pandemic. We did have diluted share count, again, very, very flat, although recently they have started to increase a little bit. And then, of course, diluted EPS has also been a little bit more back and forth, negative in 2020, but then also rebounding once again in 2021, 2022. 33% gross profit margins. We do have net margins at under 5%. Free cash flow margins at over 6%, return on common equity, capital, and assets also at around 2 to 3%. So it's not the most efficient business in the world, but definitely it is, again, a strong brand name in the world. Now, valuation-wise, Disney does trade at maybe a little bit of an expensive valuation at 26, 23 times earnings on a non-GAAP basis. Price to sales trading at a little bit over under 1.8, just over 1.8, under 2, and price to cash flow at 17 to 23. So it is a little bit more on the expensive side, and EPS expectations are going to be from $3.73 to over $8.45. Now, if I plug in those numbers into my calculator, my fair value ended up at around $80, being on very conservative side. And that's also why I'm actually super excited and interested in Disney at this second, because, it's trading at a very good technical support. So this right here, the green rectangle you see over here, this is a potential support. This is an area of demand. This is exactly where we were during the pandemic before Disney pretty much rallied, I think, over 100% from those levels, 160%, going up to over $200 per share. And from those all-time highs from back in March 21, it is down almost 60%. So it has definitely underperformed, but now it's once again trading at a support at around $86. My intrinsic value, fair value, the previously calculated one, is going to be at closer to $80. And of course, not to mention the technical support is also there. So we do have a potential swing trade setup and a potential investment setup here for Disney. Although I do want to mention the balance sheet is one of the worst for Disney. So if you come over to the balance sheet, net debt, they're sitting on over $38 billion of net debt, meaning they've got a lot more cash than debt on the balance sheet. It's been increasing since 2018. So I'd be careful there. But from a swing trading perspective, it does start to make a lot more sense from a risk reward standpoint at closer to $85, $86 with a resistance and target up to over $103 per share. Again, earnings super critical at a support, intrinsic value closer to 80, balance sheet still a bit of a concern, and now the business model is once again shifting a little bit away from streaming over to entertainment parks as well. So let me know your thoughts down in the comment section below, and what do you think about Disney? Are you buying, selling, holding? What are your thoughts? As always, if you enjoyed this video, find it helpful, make sure that you drop a like, subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course being a part of our money investing community. As always, happy investing. I'll see you all in the next video.